Okay, on today's episode of the Investing City podcast, super excited to have Jonah Lupton. So thanks for being here, Jonah.
Thanks for having me, man. I appreciate it.
Yeah, no problem. So first, I just want to start with a little bit of background. How did you first get interested in investing, and just tell us a little bit about how you got to where you are today?
So I actually went off to college as a pre-med major and went off to UNH, did the first year of, the core science classes, biology, chemistry, all the stuff you do in high school, just a little bit harder. And I didn't love it. It was just a lot of studying, which I guess I didn't truly appreciate before I got there. And then as soon as I got to organic chemistry, that's when I basically decided I didn't want to be a doctor anymore, because this was the amount of studying that I had to do it was ruining the college experience. And I know you're there to learn, but you're also there to make friends and have some fun. And being a pre-med major didn't exactly line up. So I actually took a semester off from UNH, went to a community college to try to figure out what I wanted to do. My father had been in the investment business for 25 or 30 years at that point, and I'd always enjoyed talking to him about stocks and the economy and whatnot. So I sort of did a mini internship with him one summer and, got a feel for the business, and then decided that's what I wanted to do. So I transferred to a different college, Salve Regina, as a finance and business management major, finished top of my class there. And then I got a job at Morgan Stanley, which is where my father was. So I kind of teamed up with my father. This was back in 2002. So I was 22 years old, didn't really know much about the markets, probably knew more than most 22-year-olds just from what I'd learned from him. But still, I was, very rough around the edges. And when you start in the business, back then, and you don't have a network of, friends and family or rich, former colleagues or anything you can tap into to try to generate clients, you're literally dialing for dollars. So you walk in, after you get licensed, you get your own little cubicle, and they give you a phone book and a phone, and they tell you just to start calling everybody you can, literally out of the phone book. This is before the do not call list. So that's what I did, 8 hours a day, 300, 400 calls a day, with my little flashcards, making notes on people and trying to get them to open up about their financial situation and, their investment account and who's managing it and how they're doing it. It's brutal. It really is a brutal way to build a business, but that's the only way to do it. And then, a few years goes by, you build up some clients, and then you're obviously managing clients. And I did that for a few years at Morgan Stanley, then Smith Barney. Then I ran a couple teams up in Boston for some trust companies. And then in 2011, I just decided to leave the business. I was kind of, after the financial crisis, I was just done with Wall Street. I was done with all the crooks in the mortgage business and, all these clowns on Wall Street and the investment banks that basically took down the markets, with their shitty, subprime collateralized crap and, the rating agencies. For anyone that wasn't in the business back then, they may not know what I'm talking about, but there was a lot of dirty stuff happening and a lot of people getting rich off that dirty stuff. And I just it just ruined my, I don't know. I needed a break from the industry. And this is when, tech and startups were getting very hot. So I thought that I could jump into the tech world and, become a successful entrepreneur, doing some app or social media site. So I created an incubator in 2012, brought in a dev team, and we were kind of building our own apps and websites, sort of the spray and pray approach where, you take a couple $100,000, you start 5 companies, you give each of those companies 40K and see what happens. And then the companies that actually start to build some traction, you pour more capital on them and accelerate the growth. But it didn't really work out that way because there I am trying to run a dev team, a design team, 5 startups at the same time. And it was chaos. So nothing really took off the way that I expected it to. And then fast forward to 2015, or maybe 2016, when I had the idea for SoundGuard, which was to create a soundproofing paint for walls that we could then sell to hotels and apartment complexes. So I did that for 4 or 5 years, raised some capital, about $600,000 or $700,000 from investors. I put in some of my own cash, of course. The business was starting to finally grow, building the team. We had probably $2 or $3 million of projects lined up for 2020. and then the pandemic hit and basically wiped it all out. So, back in last April, May, June, I was dealing with some serious depression as I watched my company that I spent 5 years slaving over basically disappear in the blink of an eye because of a virus. So it took me a few months to kind of grasp, deal with that from like an emotional standpoint. And then, I sort of gravitated back to what I knew, which was investing and stock research. So I started, building up my own portfolio, managing my own stocks, and then sharing it on Twitter. And then I found FinTwit, and that was kind of an eye-opening community to get involved with, sort of saved my life in a couple of ways. And then just got really transparent, started publishing a Substack newsletter, opened up a StockTwits room. If anyone goes to my Twitter account, you can see my portfolio. It's in a Google Sheet. It's pinned to my account. So I update it every day. So everyone actually knows what I own and my actual position sizes. So I'm really transparent, maybe to a fault, because it probably does determine my investment strategy a little bit. Like if I wasn't so transparent, I'd probably be even more aggressive on some of my positions or more active with my trading. But since a lot of people watch what I'm doing, I need to be mindful of that and not send the wrong signals to people. So, I have to try to find the right balance there. But so far it's been going great. And then recently I was picked by Chamath and Social Capital to start running some money for them. So back in, I think it was November, Chamath announced that they were going to do this search for what they call emerging managers. And they were going to pick 10 or 11 people, I think give them about $5 million each to start with. So like a total pool of 50 million. And then, over time, obviously, if things were going well in their particular fund, they could expect to, see an increase in cash coming in. And then the idea being that, gives you a platform to start establishing a track record and learn how to manage institutional money, larger position sizing, getting in and out of positions, which is, the more money you have, the more difficult it gets. I mean, when you're running your own portfolio, you don't have to worry about moving stocks. And since I'm now focused on smaller companies, getting in and out of positions is something I have to put more, time and thought into. But at the end of the day, like I'm still a long-term investor. I'm buying, I'm putting a lot of research into my positions. And if I'm going to do that, I'm not looking to flip them. Yeah. And sometimes it comes back to haunt you. You say you're a long-term investor, you get into a stock at 12, the next week it's trading at 24. And it's like, what do? I just made 100% in a week. I still like the stock long-term, but I also didn't expect to see 100% return in a week, right? And if I was running my own portfolio privately, I probably would have sold it up 100%. But since, so many people are watching what I'm doing, I don't want to look overactive in that sense. And then also, if I'm going to be running an institutional fund someday, maybe an ETF, I need to show people that I can manage risk and handle, 30, 40 positions at a time, not just run a concentrated portfolio. So, the last 6 months has taught me a lot. And then I expect to learn even more as I'm running money for Chamath and then these other emerging managers. Hopefully we can all learn from each other because I think we all bring a different background and strategy to the table.
Yeah, thanks for sharing that. I really appreciate it. So it's interesting what you bring up with like when you have eyes on your portfolio and wanting to make sure that you're cognizant of that. So if you had your ideal portfolio, just tell us a little bit about the style and how exactly you would invest and really try to maximize your returns.
So last year, 2020 was a year to invest in, I think, themes, themes more than anything. And then, if you look back on the year, the best strategy was to buy the riskiest stocks that you could, that got absolutely hammered in March and April and then saw the biggest bounces. Neo, Penn Gaming, these stocks got down into like $2, $3 a share. And now they're up 10x, 20x, 30x. So, that would have been the way to play it. But, just on my, based on my experience, typically when stocks get below $5, like you have to worry about the longevity of the company and can they actually stay in business, and do they have a balance sheet that can, withstand a significant pandemic. So those were all the things that scared me, and that's why I didn't jump into a lot of those low price stocks. But 2020 was all about themes, e-commerce, digital payments, online gaming, And then as we we got into the later half of the year, as it looked like the, Democrats might take the White House, then you started to see the rotation into, EV and cannabis and infrastructure. So that's sort of how I played 2020. As we got into the fourth quarter, I started transitioning out of the hot names from 2020, sold off a lot of my cloud stocks, got out of Zoom, got out of Peloton, et cetera, got into a lot of the EV and cannabis companies, including some of these new SPACs. So I love SPACs. I mean, we can talk about those. So I look at SPACs differently than some. Yes, there is some risk there because they're not going through the traditional Wall Street underwriting process, presentations to the analysts and the big mutual fund companies hoping to raise money from them. Instead, they just have to get a group of the SPAC sponsors to basically do their own due diligence, put together a presentation. But I look at SPACs as a way for retail investors to now participate as the kind of the late stage of VC money. So the companies that we see coming public right now at, a $1, $2, $3 billion market cap or enterprise value, these companies used to stay public 4, 5, 6 years longer and then go raise, the D round, the E round, the F round. And then by the time we see them as a public company, it's a 15, 20, $30 billion market cap. I mean, look at Roblox did. Roblox just postponed their IPO because they were talking about doing one at like 10 to 15, and then they decided to raise more money at like 30 or 35 billion. Airbnb came public at 80, 90, 100 billion. So I love the SPACs, giving retail investors a chance to kind of jump in early while these companies are still in hyper growth mode. Now, obviously that means more risk, that means less revenue, that means no profits, but you kind of get a chance to get in, in the second or third inning rather than the seventh or eighth inning. And then that sort of fits into my strategy overall. So last year was really for me about thematic investing. Now it's still about themes. I mean, there are certain themes and sectors that I gravitate to, but for me, it's also about market cap and size. And, as I'm running my personal account, as I'm running the fund for social capital, as I'm hopefully going to be running this ETF at some point later this year, I'm really focused on small and mid cap stocks under 10 billion market cap, with significant growth or strong fundamentals. Like I said, I mean, if a company's growing at 100% a year, they're probably not profitable because that's just not their focus. They're focused on growth and market share, but I understand that. And I'm focused on companies that I think can 5X over the next 5 years. So and this is why I sold DocuSign last week. So as much as I love DocuSign and I use their product every single week when I'm sending documents to people, tremendous value, they're now a $43 billion company. I don't think DocuSign is going to be a $200 billion company in 5 years. The same reason I sold CrowdStrike. CrowdStrike is still best in class for cybersecurity. However, they're a $48 billion company, and I don't see them as a $250 billion company in 5 years. So if the companies no longer kind of fit that thesis, then I just have to let them go. And hopefully I can find a similar company, with a smaller market cap, but that's tough too. And that's what I'm kind of struggling with right now is I want to be in cybersecurity, but I can't find any stocks under 10 billion that have the same strong fundamentals as CrowdStrike. So right now I'm not in cybersecurity. And I've looked at, Rapid9, and I've looked at, I think it's Tenable, TENB, but they're growing at 20% versus CrowdStrike that's growing at 45 or 50. And I really try to stay over 30%, which gives me a better shot at hitting that 5X in 5 years, which is a 38% CAGR. So like I try to be in that 35 to 40% revenue growth range, because if you don't see any multiple expansion, then at least you have a very good shot of hitting that number. Obviously, if you get, the 35 or 40% revenue growth plus some multiple expansion, that's when you get the 50, 60, 70% annualized returns. So, and then just in terms, so I'm not even sure what exactly the definition of a mid-cap stock is anymore. I think it used to be over 5 billion, but that might have even come up now since there's so many 50 and 75 and $100 billion companies. But so I'm somewhere between, like, I try not to go under 100 million, for the same reason I talked about before, is that people are watching my portfolio, following me into positions. So I don't want people chasing me into these microcap stocks as much as I might love them. So there's a couple stocks around $100 million in my portfolio. The bulk of them are sort of in that $1 to $5 billion range. And I know we're going to talk about some of them, Durham Tech, Upstart, Porch, etc. So, but these are all companies that are growing at anywhere from 50 to 250%. Leaders in their category, but that category is either new or it's expanding rapidly, as we'll talk about with kind of these companies now. So
Yeah, so why don't we jump into the first one? That was a great foundation to lay. So maybe Durham Tech, I know you're excited about this one.
So Durham Tech's my biggest position right now. I heard about this stock maybe a month and a half or two ago. I forget exactly, and I forget who put it on my radar. It might have been someone in my StockTwits room. And the first thing I do is I always look at the fundamentals. So I usually go to Ticker, Yahoo Finance, some other website, look at the fundamentals. The company has very little revenues. And then you look at the stock chart and you're like, oh my God, this thing's already taken off from 10 to 30. So you're like, I don't want to chase it here. This is when people get crushed. But then you dig into the story and you're like, oh my God, this story is incredible. So Durham Tech is a company based in California. And what they do, or at least how I describe them, they've created a genomics smart patch. So the old way of detecting skin cancer for dermatologists or oncologists is to look at the mole on your body under a magnifying glass or just with the naked eye. And then if it looks suspicious, then they order a biopsy, which is basically they're cutting off a piece of your mole, sending it to the lab to be analyzed to see if there's anything that's concerning. That's the old way. What Durham Tech is doing, a completely non-invasive method of the dermatologist would take this smart patch, which is about the size of a quarter, rub it on your mole, and then put it back in the pouch and send it to their processing lab in California. And their processing system with lasers and everything else can determine, at a DNA level, if there's any, early signs of skin cancer. So it's faster, it's more effective or more accurate, it's cheaper, and it's non-invasive, right? Because they're not cutting into your body. So there's 4 million biopsies every year, and 90% of them come back negative. So 90% of those people essentially got a mole or something cut off their body that didn't need to be cut off if they had used this Durham Tech patch instead. So, skin cancer, there's 3 different main forms of skin cancer. Melanoma is one of them. Right now, this patch is detecting melanoma, but they also have other products in the pipeline that'll help detect the other forms of skin cancer. So skin cancer is the most common form of cancer in the US, but it's very treatable if you catch it early. So the earlier the better. And what this company is going to be able to do is help dermatologists catch skin cancer sooner. And I think patients will feel more comfortable, with a patch, literally that doesn't hurt, doesn't rip off any skin. So it's just a much better way. And I think as soon as a doctor does the biopsy and it comes back negative, and then that patient finds out that this patch was available, and that patient sues that dermatologist for malpractice, forget it, game over. Like, you will not get another dermatologist opting for biopsy over the patch. And there's really no reason to. And the NCCN, which is the National Cancer Comprehensive Network, which is like the gold standard for products like this. They're the ones that set the guidelines for people in the cancer field, the oncologists, the dermatologists, etc. And back in December, they reviewed it, the test results, the peer reviews, all of that, and they gave it their gold stamp, their stamp of approval, and that's why the stock took off. So once you dig into the story and you find out why the stock accelerated so much, then you're like, okay, that was absolutely warranted. Now where does it go from here? So I sort of, I do my 5-year projections on the company. Now, I also look at a stock like Exact Sciences, so EXAS. Now, they're in the colon cancer space, but they're similar enough where you can draw some comparisons. And if you look at the revenue growth for Exact Sciences and the stock charts, I mean, it's insane. The stock's up 20x over the last 5 years. and the revenue growth over the last 5 years, I believe, was around a 200% CAGR, maybe a little bit lower. And I think Durham Tech could absolutely do that, right? If you look at the total addressable market as those 4 million biopsies, and that doesn't even include like some of the other products in the pipeline, but even if they converted just half of those biopsies to the patch first, I mean, you're looking at, I think, $700 or $800 million in revenue. So that's sort of where I see the company going over the next 5 or 6 years. So last year they did 6 million in revenue, which is obviously nothing. This year the estimates were 12 million. But if you look at the fourth quarter volume processing from the California facility, if you take the fourth quarter numbers and annualize them for 2021, they'll crush that $12 million estimate and probably come in somewhere between like 25 and 30. So things are absolutely accelerating over at Durham Tech, you know, because I mean, there's like something like 5,000 dermatologists in the country. And if, you know, just a half of them start recommending this patch this year, you know, this company is going to go on to do some pretty big things. So that's my biggest position. It's just hit about 10% of my portfolio today. So even though I have like 38 stocks in my portfolio, Durham Tech is 10%. So significant overweighting compared to even my second biggest position, which is Upstart at about 7.5%. So what Upstart is, so Upstart was started by an employee from Google. And then he brought in someone from Peter Thiel's like Thiel Fellowship Program, and then one of his former colleagues from Google. So when Upstart first started, they were doing what they call P2p loans, so person-to-person loans. And I didn't really dive into it too much because they pivoted out of that pretty quickly, but it just wasn't really scaling. I mean, I get the idea, like if I have $100,000 in my bank account and, you know, 20 people around the country need loans and can't get it from the bank, you know, I guess I could lend them my money at a, you know, higher interest rate, but I don't know. I can see where some people wouldn't feel very comfortable with that. So before, they were actually running out of money and they went to the investors. And I think they offered to give the money back to the investors, whatever was left. And the investors were like, nope, you have 3 more months to pivot into something else. So figure it out. So they decided to start building an AI model to help with underwriting. So underwriting in this country is a shit show, and it's mostly done with FICO scores. And a lot of underwriting departments, because I've worked in banks before, so I know this, you know, it's still done by humans. Like it's still humans that actually make the final decision on whether or not someone gets a loan, whether it's, you know, a personal loan, an auto loan, a mortgage, a business loan. Like there's still human touch to that process. And Upstart is trying to eliminate that. So they created an AI model. Right now, actually, it started off as personal loans, and then they've actually started doing auto loans as well. But the typical FICO score is like, it's a joke. I mean, it's like a tiny snapshot of your credit and payment history where all these other factors really should be accounted for. And that's what Upstart does. Everything from, you know, where you live, where you went to college, your grades, like tons of stuff. Now, it's 1,600 data points, and they don't, you know, disclose what they all are. So, you know, you kind of have to guess. I don't know how you'd even get to 1,600, but they've started working with partner banks. So what they do is they're basically like a white label AI platform powering the underwriting department for the banks. So the banks are out there, you know, driving traffic to their website. People apply for a personal loan anywhere up to $50,000, I believe. And then, you know, that's where Upstart's model kicks in. And within like 60 seconds, that person's, you know, either going to get approved or denied. But it's very fast. It's very accurate. And so far in the first couple of years or few years, they've been able, so banks have been able to approve twice as many loans without increasing their default rate. So you're basically doubling the revenue for the bank by using Upstart instead of using their own, you know, Joe and Mary in the basement approving loans by hand. So just a much, much better model. And then, you know, the company's already alluded to getting into other, you know, segments of the credit market. So auto loans is already happening. I would expect them at some point to get into mortgages, student loans, credit cards, business loans. I mean, commercial real estate. I mean, who knows how far they can take this thing. There's really nobody else, as far as I can tell, there's really nobody else doing it this well, you know, already. not to say that other companies aren't working on it. Could Bank of America, JP Morgan develop their own AI models? Yes, probably. But, Upstart already has a 6 or 7 year head start on them. So I'm not sure why they wouldn't want to just license the model from Upstart. And then on top of it, because Upstart has all the data from all of those customers across all of those banks that are making payments on or missing payments on Upstart loans, they have that data, and that data is being used by the model to keep improving itself. So, as they grow, the model's going to get smarter and smarter and better over time. But it's giving more people more access to credit while not improving default rates. But it's also allowing banks to provide loans cheaper because they don't have so much human underwriting cost involved. I mean, it's like this is where technology is replacing humans. Instead of having a 20-person underwriting department at a bank, maybe now you only need a 5 or 6-person underwriting department, right? So 14 people could theoretically lose their jobs, which sucks. I feel bad for them. But at the end of the day, that's the way the world is going. I mean, we're being taken over by, improved technology processes. So I think, I say that Upstart is the future of underwriting, and the credit markets globally is like $100 trillion market. It's freaking huge. Third biggest position is Porch. So this was my write-up this past week on my Substack newsletter. So Porch is interesting. So I've been looking for a small cap way to play the real estate space and sort of the boom of people moving out of cities into suburbs. And, I'm sure I'm not the first one to say this, but, with the pandemic, a lot of people are getting out of the cities and, moving into homes or suburban communities for more space and backyards. And because now they can all work from home, the 3 obvious ways to play it are Zillow, Redfin, and Opendoor, but they're all much bigger companies, or they've all had, like Redfin, I think was up 300% or 350% last year. I really don't want to chase it here. So Porch is interesting because what Porch does, so Seattle-based company, been around for about 7 or 8 years. Technically, it's called Porch Group because it's like 7 or 8 different brands and companies underneath, one of which is Porch.com. And then they've done, like just in January, they acquired 3 or 4 different companies. So, even though they're a small company, market cap just over $1 billion, recently came public via SPAC, like they're definitely doing the whole roll-up strategy, very, in terms of like moving services, insurance services, these are all very fragmented markets. So they're trying to, grow the company, not just organically, but also through accretive M&A deals. So essentially when they first started, they were kind of a marketplace like Thumbtack or Angie's List to connect contractors with homeowners, for different types of contractor services. And they still do that. Like that's definitely still part of their business model. But what they're also doing, they're trying to become like, so I call them the homeowner operating system, where they partner. So they develop software for inspection companies and moving companies. So an entire like ERP, CRM software platform for those companies to run their businesses. And then what Porch did was said, okay, you can either pay us a monthly SaaS fee for the software that we developed for your industry, or you can use the software for free, but you have to give us your entire customer database. And most of them are actually giving them the customer database. So what Porch is able to do is leverage the software into early access to people as they're getting ready to, sell their house, buy a house, move, state to state, whatever. So these are like the prime customers for a company like Porch, because as those people move from one city to another or one state to another, like they need to find all new contractors, cable providers, security companies, like they're starting from scratch. And Porch is there, 6 weeks before they move to basically, act as that operating system and help them find all the products and services they need to make their move easier. So really, like I call that one of the best customer flywheels I've ever seen, where they actually develop the software and give it away for free in exchange for like, the inspection companies' customers and moving companies' customers. So really interesting. The company would have grown this year at about 70% top line growth because they did some of these M&A deals. It looks like growth can be, they just raised their revenue estimates this year to 130%, and gross margin should come in somewhere around 79%. So, whether you're talking organic growth or growth through, M&A, 130% top line growth with 79% gross margins and $1 billion market cap is a pretty interesting story to me. So, and I don't think this real estate boom is moving anytime soon. I think, it's going to, with interest rates this low and people wanting to get out of the cities because they don't have to work in the cities as much anymore. Like, I just think this is good. This real estate thing is going to continue. So, next stock is Mohawk. So I know Mohawk's been all over FinTwit recently because it's every day it feels like it's up another 5 or 10%. It's actually up 10% today. There are a couple ways to explain them, I guess. So I call them like an AI-powered consumer products company, consumer goods company, but they're also doing a lot of M&A as well, accretive M&A deals. They did one yesterday for an essential oils company. They paid like 3.5 times EBITDA or EBIT. So that's I think that increases, that brings like, I want to say 60 million to the top line and like 15 million to the bottom line. I forget the exact numbers, but either way, it's definitely accretive for the company. But what they do is, so they use the APIs from Amazon and I believe Walmart Marketplace to determine where the big trends are, where searches are happening, but what categories are being, where there's a pickup in searches for a particular category, but the products in that category are not meeting the customer's needs, and you're seeing, below average reviews for the top products. And then that's where Mohawk works with their overseas partners to develop a product for that category and get it onto the marketplaces within 6 to 9 months. So they have a very, what's the right word? Nimble, I guess, agile, I guess agile is probably the right word. A very agile kind of like manufacturing, sourcing, like infrastructure. I believe most of it's happening in China, but they do talk about like they're able to, identify these trends, identify these opportunities, and actually get a product, designed, manufactured, and shipped over in some cases within 6 months. So, and they're another company growing. So even without these last couple M&A deals, I mean, they would have grown probably 60, 65, maybe 70% this year. And with a couple of these M&A deals, they're actually going to grow about 100% year over year. And they should be EBITDA profitable this year, maybe even net income profitable. And it's still a small company. I mean, this was a stock that I jumped into in December at about $12. I wrote about it in my Substack on, I think it was December 21st when it was about $12.50 or $12.75. Now, today it's at 32. So, I mean, it's had a monster move in the last month and a half, but the market cap is still just $685 million. They should do, so they guided yesterday, I believe they raised guidance from 300 million up to 350 million. And I know people that know the company even better than me, and they think the company has a shot at doing 400 million this year, even without more M&A. And then obviously some M&A could even push it higher than that. But let's just, even if they only do 350 million this year, the company's still trading at less than 2 times sales. Like, it's a joke. Shopify obviously is a different company. But when you see a company like Shopify trading at, 30 times sales, and then you see a company like Mohawk at 2 times sales, like, it's bonkers. Like, sometimes I hate myself for not just loading up, and having 50% of my portfolio in Mohawk, from 6 weeks ago. But, like, you still have to worry about these micro cap or small cap stocks. Obviously they depend greatly on Amazon and Walmart marketplaces. So if anything was to disrupt that relationship, obviously that'd be bad for the company. So, there's obviously risks and concerns with any of these smaller companies. But for all of the brands that they own and operate and then acquire, they also have their own independent Shopify stores. So not all of their sales are happening on the marketplaces. Some of them are happening direct to consumer on those Shopify stores. So, Mohawk definitely relies on Amazon and Walmart, but it's not exclusive. So just a really interesting company. I've talked to a couple of the founders before. They're very open and transparent, which I obviously appreciate. So very cool company to be on the radar. And even though the stock's moved from 12 to 32 in the last month and a half, I mean, I think this could be a $50, $60 stock by the end of this year, just on valuation alone, and, easily $100 stock by the end of next year. And let's see, do you want to do one more?
Sure, one more. That'd be great. Thanks.
Okay. So another stock I wrote about recently is Inspire. So Inspire Medical, the website is inspiresleep.com. Very interesting company. So sleep apnea, and then even more, and then obstructive sleep apnea. So they're a little bit different, but there's 20 million people in the US that suffer from sleep apnea and 100 million people around the world. So it's a massive market. So obstructive sleep apnea is obviously the more serious one. And that's, I think 8 or 10 million people in the US suffer from that. And the overwhelming majority of them have to sleep with a CPAP machine. And if anyone knows what a CPAP machine is, I mean, Google it, because it's going to blow your mind. You're basically sleeping with like a big gas mask on your face, hooked up to a machine that's basically forcing oxygen, through your airway. Because what happens is when you sleep on your back, if you have obstructive sleep apnea, your tongue is relaxing into the back of your throat and blocking your airway. So that CPAP machine is forcing forcing air, I believe, through your, down into your lungs so that you don't suffocate. So people that have sleep apnea, like they constantly wake themselves up because they think they're suffocating. Like it's horrible. I have it. Now I sleep on my stomach because I refuse to sleep with the mask on. So I sleep on my stomach, and now I have back problems and neck problems because of it. But it's definitely better if you can sleep on your back. It's a much healthier way to sleep for your body. So what Inspire does, which is crazy, they created a device that gets implanted on your chest wall. It's small. It's like half the size of a credit card. And then it's hooked up to, so there's like a little wire basically that goes to, I think it's called the hyperglossal nerve, which is the nerve that controls or stimulates your tongue. So what this device does, and you turn it on every night when you go to bed, like there's like a little remote control that you put over your chest and you turn it on. So while you're sleeping, the device detects when your lungs are trying to take a breath, and then it sends a signal to your tongue to move out of the way so that the air can get down into your lungs. It's crazy. And it's, it's an expensive surgery. It's $25,000 to $30,000, but almost every insurance company now covers it as long as you prove to them that you have sleep apnea. So you have to do like the sleep study, which I've done before. And in some cases, you might have to try the CPAP machine for 6 months. But I actually know a couple of people that have had the surgery, and they said it's life-changing. And they echoed that, where they had to try the CPAP machine for 6 months, basically say, this thing sucks, I can't sleep, I want the surgery, and then the insurance company will authorize the surgery. But just a really cool company, still in hyper growth mode. I think even though the stock hasn't gotten really depressed, or the stock had a nice bounce back from March, I think it's bounced back because people realize that this is still an elective surgery. So there was a lot of demand that couldn't happen in 2020 because of the pandemic, but then now a lot of that demand should bounce back. And like I said, I mean, the company's done, I believe it's 13,000 surgeries over the last 4 or 5 years since they got FDA approval. So that's another important thing. Like they already have FDA approval. And I think there's like 550 like big commercial sleep clinics around the country. And, their sales force obviously is going out to those sleep clinics to, educate the doctors on, this new technology and surgery. And I don't really understand, like, I dug in obviously a lot to the company, but I don't understand the insurance side of it. So I don't know what the doctors make, like, the sleep clinics, like, do they make more money if they recommend a CPAP versus this? I don't know. Like that stuff's over my head. I mean, I just focus on Inspire and the technology, phenomenal gross margins, growth is like 60% top line. Gross margins are, I believe, around 85%. And when you see that they've only done 13,000 surgeries, and there's like 8 million people that wear CPAP machines every night, like that's just a lot of runway to go. And there's nobody else in this market that's doing this. So they're the only, so it's called minimally invasive. So they're the only minimally invasive FDA approved technology for obstructive sleep apnea. So cool company. It's obviously a position of mine. It's like my 11th or 12th largest position. Market cap is around 4 billion, I believe, still. Stock got up to about 228 a few weeks ago, pulled back down under 200, which is when I kind of doubled my position from about 2% to 4%. So I keep typing in the ticker wrong. Hold on. USP. Yeah, I'm pretty sure the okay, market cap's 5.7 billion. So, but it's still under that 10 billion that I try to stay under. Now, I mean, even though I'm focused on companies under 10 billion, like these are companies that I plan to own for the next 3 to 5 years. So, even if let's say Inspire doubled over the next 3 years from, 6 billion to 12 billion, I would most likely still hold on to it as long as the fundamentals, kind of met my requirements, which is at least 30-40% top line. So I really have no interest in touching any company that's under 30 to 40% top line growth, unless, the estimates are below that. But I believe that they're going to beat the estimates and then fall in that 30 to 40%. So that's kind of how I do it.
Gotcha. Yeah, thank you so much for sharing all those ideas. Some really, kind of under the radar companies that probably not a lot of people have heard, maybe outside of FinTwit. And so I really appreciate you being generous with that. So just a few more questions. So you've laid out kind of your philosophy very well, but talk a little bit about portfolio management rules. How do you start a position size? When do you add and take away?
So, I mean, right now I have 38 positions, which is a lot. Last year I was trying to stay under 20 or 25 positions, but I was also investing in larger companies, Square, C Limited, Teladoc, CrowdStrike, Tesla, Facebook. So, those companies are, I mean, there's, 20, 30, 40 analysts on each one. Everyone has a pretty rough idea of where the estimates are going to come in. So you don't get any big surprises. So you don't get, massive drawdowns in most cases. So it's easier to kind of know your downside when you're investing in those types of companies. Although, Fastly got hammered at one point last year when they lost Teladoc. And, just from my background, I mean, when you're investing in companies that are trading at 30, 40, 50 time multiples, there's no room for error. I mean, if they miss on a quarterly number, that stock's going to get hammered because now that valuation, that extreme multiple is no longer justifiable. So that's been, my strategy for the last month or two is to start getting out of those higher multiple names that did so well last year. Fiverr, Peloton, where the valuations are definitely a little stretched, and I just feel like those companies could trade sideways for a while as the fundamentals catch up to the valuation, or the valuation comes down to the fundamentals. So either way, I just feel like there's better opportunities in the market. So for instance, like a couple weeks ago or a few weeks ago, I sold my Twilio and got into bandwidth. So Twilio is obviously a great company, growing at 35%, CPaaS platform. They bought Segment, they bought SendGrid. I mean, they're doing a lot of great things. It's also a $60 billion company trading at 24 times sales. Bandwidth is also a CPaaS company, owns their own tier 1 network. They were trading at 8 times sales with the same growth. So it's like, why do I want to own a $60 billion company at 24 times sales with 35% growth when I can own a similar company at a $3 billion market cap with 35% growth at 8 times sales? So, that's where I think some of these smaller companies don't get enough attention or love, even though they have some really strong fundamentals. And like some of the larger companies in their space are trading at extreme valuations, compared to theirs. And I just think that has to change. So I think some of these smaller companies are going to go on some really nice runs over the next 6 to 12 months and, start to catch up to those bigger valuations, those bigger multiples. In terms of position sizing, so typically I'll do 2 to 3 hours of due diligence on a company in order to start a position. Normally, I'm going to start it at 1 to 2%. So yesterday, I started a position in App Harvest. So it's a recent SPAC company. Valuation's definitely a little stretched, but I think the story's really, really interesting. I mean, it's basically an indoor vertical farming company that's like insanely efficient versus like regular farming outside, where you have, unpredictable temperatures, unpredictable weather, lots of lost yield, I believe they call it, versus the controllable indoor, temperatures and everything. So you just get a much, much higher yield out of a company like App Harvest. So, just like I think Upstart is the future of underwriting, App Harvest might be the future of farming. Like it's still very early for them, but this is the kind of company that's going to grow at 100% a year for the next few years. So I would rather get in early than late, and that's where ARK Investments. I love them. They've crushed it. Incredible track record. Kathy's amazing. The team's amazing. I own their ARKG, their genomics ETF, but they're now managing like 60 or 70 billion dollars. And I wouldn't be surprised if they hit $100 billion by the end of this year. That is a ton of money to manage. And when you're managing $100 billion, you can't invest in billion-dollar companies anymore, because you own it would be such a tiny, tiny piece of your fund that it just wouldn't, it's not even worth them doing the homework and the due diligence if a position is going to be that meaningless in their portfolio. Like the only reason they'd add a billion or $2 billion company to one of those ETFs is just window dressing. It's not going to move the needle. It's not going to enhance performance at all. And it'd be very hard for them to get in and out of those positions without moving the stocks. So you've already seen ARK focus or, gravitate now towards the larger companies. When you see their activity coming out every day at 6 o'clock in that email, it's a lot of the bigger stocks. It's Google, it's Apple. I think, they're buying Tesla again. I think they actually started buying Roku again after selling it a couple weeks ago. So like those are the names, Alibaba, those are the names that they're focused on. I want to focus on those smaller companies. I want to focus on what I call the emerging disruptors, these $1, $2, $3 billion companies that are not on the radar yet, where FinTwit's not really talking about them. The analysts aren't covering them. The big Wall Street funds haven't jumped in yet. And we have a chance to get into these hyper growth companies early on before the big boys do. And then, as they jump in, as these companies start to get some coverage, buy ratings, the price starts to move, we're the ones that got in early and we get to benefit from that. So, it just depends. Like, so App Harvest, yesterday I jumped in around 40 and then the stock pulled back to 35. So I doubled it. And then this morning it pulled back to 34. So I increased it a little bit. So now my cost basis is like 36. But I mean, this is the kind of stock, like I'm not trying to flip this stock. I'm not trying to sell it next month, for a 50% gain. This is the kind of stock that I would rather hold for the next 2 or 3 years and just buy on the dips, and that's why when we have these big red days, I sort of applaud because it gives me a chance to jump into some of my favorite companies at cheaper prices. Like I hate buying stocks on green days. I would much prefer to buy stocks or add to my positions on big down days. Like way more easier for me. I hate chasing stocks, but if you're a long-term investor and you have a 3, 4, 5 year time horizon, like I will with my ETF or even my personal account, like Mohawk, I mean, I'm probably not going to add any Mohawk today at 32, but I added to Mohawk yesterday at 25. It started out in the morning, I think at 26 or 27, pulled back to 24, 25 around just before lunchtime. I added to the position because I think this is a $100 stock by the end of next year. So like, I don't want to wait. Sometimes you just can't wait for a big pullback. I mean, I do a lot of technical analysis, especially with the Bollinger Bands. And I do sometimes trim when stocks, just rip too fast and start to poke through the Bollinger Bands. And so sometimes you might just get a 5 or 6% pullback and that's it. And that's all you're going to get. You're not going to get a 25 or 30% pullback to add. So, sometimes you can't wait for the perfect price or the perfect setup. You'll end up missing too many stocks that way.
Interesting. So, I mean, I like that you bring up technical analysis. I feel like it's pretty rare for somebody to steep themselves in fundamental and technical. So I'd just like you to talk about that just a little bit.
So I was never a big technical guy. I got into it more probably 6 months ago, especially with TrendSpider. So, in full disclosure, TrendSpider is a sponsor of my stock contest. But the reason I wanted them to be a sponsor is because I am a big fan of their software. So they just make it really easy to do technical analysis. I mean, you can, create all the moving averages you want and the Bollinger Bands, like literally anything with just the click of a button. So I use technical analysis normally to either help me find a right entry point. So for instance, like Futu, like I got into Futu in mid-December it was like 50. So the stock had just gone on a big run. I bought it pretty close to the top around 50 or 52, thinking it was just going to keep running higher because I did think it could be a $100 stock this year. And I didn't know if it was going to pull back. So I started like a 2% position. And then it started to pull back and it looked like it was going to bounce off the 20-day. And I think it did bounce off the 20. So that's when I added again. And then we got a false breakout. So it started falling and then it broke through the 20. And then it like, oh my God, it's going to come down to the 50. So it was like another 10, 15% pullback down to the 50. But once it got down to the 50, I felt at that point that could be a really good support. So that's when I actually put it into my newsletter as well, because I felt like it was just, that's where the stock was going to start to bounce. So I doubled or tripled my position right around the 50-day moving average. And that's when it went into absolute launch mode. And it hasn't stopped since because it's like $130 stock today. So massive, massive run. So I think those are times where the moving averages and the technicals can really help you determine when to add to a position or double down on a position. If you think it's going to find some support at one of those moving averages, whether it's the 10, the 20, the 50, etc. And then the Bollinger Bands. So that's when I usually am trimming a position. Now, I don't always do it. It depends, how recently I got into it, how much cash I have in my account, how far has it run off of the 10-day, how far, which of the Bollinger Bands is it poking through? So I use 3. I use the 2 standard deviations off the 20, 2.5 standard deviations off the 20, and 3 standard deviations off the 20. So I get alerted on each one. So normally if it's poking through the 2 standard deviation, like I'll just keep an eye on it. If it starts to poke through the 2.5 or the 3, that's when I might start to trim. And if it like really shoots through the 3, then I'll definitely start to trim back that position, 10, 15, 20%, assuming that at some point it's probably going to pull back down to the 10-day, and then I can re-add those shares. But, that was my strategy more in 2020 when I was in a very low tax bracket. So I didn't really care how much trading I was doing and how much capital gains I was creating for myself because I was going to be in a very low tax bracket. It wouldn't really matter one way or the other. But this year, my income will be back to normal. So I'll be in a higher tax bracket. So I'm a little bit more cautious about being super aggressive with the trimming, only to, because I really I hate paying taxes. But at the same time, like you do have to be, mindful that sometimes these stocks just get way over too heated. Like, yes. Okay. So 2 days ago, I regret not selling all of my HIMs. So I bought HIMs about a month ago at 15. It pulled back to 12. I doubled the position at 12. And then ARK Investments started buying HIMs. And then the stock was up like 30% the next day, 30% the day after, and it was up 75% in 4 days. I should have sold it, right? Because nobody expects to make 75% on a position in 4 days. And I bet 90% of the time after that happens, you get a pullback. And of course we did, right? HIMS topped out at 25 a couple of days ago. I didn't sell any, and now it's trading at about 20. So like that's, in hindsight, I probably should have sold it at 25. But of course, you just never know if it's going to pull back, when, how far, and is it worth paying the taxes on all of that if I still like the company long term. So that's kind of where I convinced myself, okay, this is a position I plan on holding for the next 3 years. So why try to pick the perfect entry or pick the perfect exit and then pick the perfect entry, risk getting it wrong, and then I'm paying all these taxes for no reason.
Yeah, exactly. No, I think that that encompasses a lot of the different aspects. Portfolio management is really tough. So don't want to take up too much more of your time, but my ending question is, do you have any daily habits that have really contributed to your success?
Ooh. So I used to say going to the gym every day, kind of a good way to get out my frustration and clear my mind. Although recently I've been spending so much time, on my portfolio and doing research that I haven't been getting to the gym as much as I would like. I mean, I used to go 7 days a week, 2 hours a day, very, very loyal. And recently it's been more like 4 or 5 days a week, an hour and a half a day. So yeah, I need to do a better job of getting back into that habit and making it a 6 day a week thing. It's also kind of hard in the winter time. It gets dark early. The markets close at 4 and then it's dark by 4:30. And if you don't get right to the gym, it's kind of harder to motivate yourself once it's dark and cold. So I think as we get into the, end of the winter and it's a little bit lighter out and, I'm on Cape Cod right now. So it's like 30, 35 degrees outside. And I ride my bike to the gym. So I didn't have a car in Boston when the pandemic. So I was living in Boston when the pandemic started, and then I came down to my parents' house on the Cape, thinking this would just be a 2 week, hiatus from the city, and then I would get back to the city, run my company, and everything be back to normal. And then of course, 10, 11 months later, I'm still here. So now I don't. I mean, I'm looking at houses right now. I'm probably going to buy something in the next few months, but if anyone knows Cape Cod real estate, it's $400,000 gets you a tear down shack. So it's brutal out there. I mean, and it's funny. I've looked at some other states, and even just a couple of years ago, the prices then versus prices now. I mean, everything is up dramatically. Even down in Wilmington, North Carolina, you could get a brand new, 4-bedroom new construction home for 300,000. Now it's like 400 or 450. So prices have really moved a lot around the country. Obviously, low interest rates is part of that. And then just the flight out of the cities. So I'm trying to buy something now before, prices go up even more over the next 6 months. So I don't have a car in the Cape, so I ride my bike. I literally, I mean, it could be snowing out 15 degrees and there I am riding my bike to the gym.
Your dedication.
Yeah, I'm kind of crazy.
Yeah, well, thank you so much for your time, Jonah. It's been a real treat. Appreciate it.
Thank you, man. Anytime. Talk to you soon.